Okay folks, welcome back. This lesson is going to be about external range demarkers and how we also work within the PD array matrix, working within premium and discount arrays. The real highlight is going to be the external range demarkers and how they work within the grand scope of things. Alright, so on the daily chart of the dollar CAD, okay, we said we have the high here and a low here. This is an intermediate term price swing. What makes this an intermediate term price swing? It's not these small little fluctuations that move back and forth. The moves that take place that have a sizable, more pronounced magnitude on a higher time frame, like a daily or a 4-hour and 1 hour, they, to me, as I classify them, as an intermediate term price swing, because I can use that to frame intermediate term analysis versus something that would be like a movement from here to here. This is too small. Okay, so it's a short-term price swing. While that's available for profitability if you are buying along in there, and that's nothing, I'm not against it or anything like that. I'm just stating that my eye, or at least I've trained my eye to look for the intermediate term price swings. Now again, what defines the intermediate term price swing is any sizable price swing from a daily, 4-hour, or 1 hour perspective. Okay, anything less than a 1 hour is not an intermediate term, and anything higher than a daily is a long-term price swing. Okay, and that would be like a weekly or monthly chart. A couple folks emailed me asking, could I get more of a better definition that would define an intermediate term price swing, and that's what it is in my mind. So, and we'll talk more about, obviously, there's plenty of examples that's coming your way with other things that we have to use for intermediate term price swings. It's just that's what we're focusing on here. And by teaching lessons and building on them, you'll learn what a intermediate term price swing. But for a student to go back and look at some of the free content, look at my video on market structure, okay, and the application of short-term swing highs and lows, intermediate term swing highs and lows, and then long-term swing highs and lows. Okay, so if you've studied that video, it's very clear as how I used what was taught by Larry Williams in terms of his application of market structure. I look for those same types of things in price action. But what we're learning here is not his market structure. It's just the classification of long-term, intermediate term, and short-term I felt comfortable with. There's some things that perspective he taught on market structure is very, very generic, and it still works today. And in fact, I used it in recent months with the dollar index, and you guys can go back and look at that video where we talked about the daily market structure and how it would go higher, reaching up into that weekly SIBI, and it did that. But as far as it goes in terms of Larry Williams' application of market structure, that's the extent of it. I took it and went further with it, and these are the things that I've more or less came to learn and understand and create. So I want to kind of cover a couple things in here, and I think I've earned the right to talk about things in hindsight. I've done enough of the things, calling it forward. But the only way you're going to really learn it is if I break them down and show you the mechanics of what led to certain perspectives, why I feel certain things are likely to occur and why they're not likely to occur. The best examples of teaching is going to be by way of hindsight, because that's what I taught myself with. I studied all of this stuff in raw price action, and no one sat down with me and said, okay, this is that and this is this, and none of that. Okay, so it takes a little bit of work and a lot of time, but trust me, if you stick to the process, some of you may be feeling like you're just not getting it. You're getting it. You just don't realize how close you are to it. So when we have an intermediate term price swing high and an intermediate term price swing low here, you want to define that range in terms of the PD array matrix. Okay, so you're going to split that in half right here. There's your 50 level. While we're in the lower half of that range, if we have a bullish inclination, in other words, if we have a slight bullish bias, While we are in the shaded area that's blue, you want to focus on buy scenarios on discount arrays on lower time frames. Okay, when we drop down to an hourly chart, you'll see what I mean by that. Everything dovetails beautifully if you understand the algorithmic principles and protocols. There are certain things you have to look for at certain times. Just because you think you understand a down closed candle may be a bullish order block doesn't really equate to always being a high probability bullish order block. Okay, so much in the same vein as I released and taught you all in the mentorship, what makes a high probability bullish order block, one of the signatures is it has a fair value gap associated with it. That's one signature, but an amplification of that would be also within a shaded area like this blue area here. Now I'm drawing this manually. I don't have indicators. I got a lot of you new folks are thinking just because I have annotations and things on the chart that I'm clicking some kind of an indicator on MT4 and it's populating the chart automatically. I do things the old way. Okay, that means drawing them out. You don't need to save 12 to 15 seconds to do these things. It doesn't take that long to do it. So if you're of the mindset that you have to have these click and populate the chart with all these little gadgets and things, you're going to really struggle with me. Okay, because I don't really believe in all that. I think that you're going to understand it better if you put your hands to it, roll your sleeves up and get to it. Okay, and maybe it's because I'm a dinosaur and that's how I started, by hand drawing the charts. But, you know, I'm the one teaching, so you can do whatever you want once you learn how to do it, and you want to create indicators for yourself. You know, not to sell it, not to give anything out to the public, or even, you know, try to teach things by way of indicators or EAs. You know, you're not allowed to take any of my content and do that. But I'm trying to institute a perspective on your analysis where you don't feel the need to by way of indicators or EAs. You know, you're not allowed to take any of my content and do that. But I'm trying to institute a perspective on your analysis where you don't feel the need to reach for these couple second, you know, time savers. You don't need all that stuff. Draw it out in time, you know, over time with your hands, and you'll see manually that you'll have a better feeling for price action because you'll appreciate it more. Clicking a button and making things pop on the chart is very, very lazy. And it just, to me, it just gives the impression that you're really not focused and you're not saving that much time. So you can argue with me all you want, but the bottom line is I've had things automated before and I got really lazy. It was very easy for me to look for something else. Okay, and if I draw them out manually, okay, if I put the levels on my 50 levels and on my big figures, you know, I'm not using an indicator to do that. I'm taking a simple horizontal line and I'm thickening it up for a big figure and using a lesser degree of thickness for a mid figure. And that's how I'm annotating the charts. Nothing on here, when I click a template and open it up, they're just simply hand-drawn annotations that I saved as a template. So when I populate my chart real quick, if you ever see me doing that, it's not an indicator that's doing it. It's literally me making notes on the chart and then saving it as a template. And then if I want to pull that information up, it's there. Okay, so I wanted to just toss that in there for extra continuity, so you guys can stop emailing me for the tools I'm using in the videos. It's all the indicators that I use are in the month 12 thread. Nothing beyond that is necessary. Everything else is going to be hand drawn. Okay, so with that out of the way, I want to talk about how price in this area here, while we're below the 50 level, on a lower time frame like a 4-hour or an hourly, we're going to dismiss the 4 hours simply for the sake of time, but we're going to drop down to an hourly chart. I'm going to show you how using the PD array matrix and the discount arrays. Now, if you have not gone to the studies that talk about this, trust me, it's in the core content. You'll want to revisit this video when you've gone through the explanation of the PD array matrix and how the PD array matrix is defined, what PD arrays are in what order, and so forth. But looking at the daily chart, anything above the 50 level is now a premium array. Okay, so anything above here, this 50 level, this is a premium array. I have highlighted one premium array simply because it's the most salient for this discussion. We have a fair value gap in here. This candle's low and this candle's high. Right here, this candle's high and this candle's low. Originally, it would have been this candle's high, but this candle went slightly higher. So it left this little bit of a fair value gap in between. Simply one candle passing through the range defined by this candle's low. And again, this candle's high. Okay. We have a BISI, buy-side imbalance, sell-side inefficiency here. Just defined by this low and this high. Consequent encroachment is right here. So on this particular day here, on June 9th, we gapped down at the open below equal lows, relative equal lows, and then we started to close in and close the gap, if you will. We had created a swing low here, this candle. So now we have a swing low. Once that forms, this day right here on the 10th, let me put it on there so you can see it again. On the 10th, you want to start going into your lower time frames and seeing if price is respecting bullish discount arrays, with the expectation that we trade back up into the bearish order block and the buy side liquidity resting above these highs into the fair value gap. Notice also that it is also a confluence of this down close candle here and these two down close candles. Either of these, okay, are going to be a premium array. We have breakers and mitigation. So there's several things in here. Just because of this range defined being high here and low here, we can look beyond that a little bit, because think about how we look at breakers. We have to go a little bit further to the left. You can see the breaker here, a mitigation block in here. Everything that you would look for resistance theory, okay, or buy side liquidity to offset your long position. So you're going to sell to those individuals that would be interested in buying at a higher price. That's what we're doing. We're pairing orders. The interbank price delivery algorithm facilitates the means for smart money to engineer, offset, and purge liquidity. If these functions were not available, we would have a completely random market. And I believe if that were the case, randomness would cause a very true absence of continuity and longevity in trading. No one would be long-term profitable. It would be too random. It would be the same thing as people playing the lottery. Okay, the odds would be so far against you that nobody would do it. But obviously, you've learned that there's ways that we can be consistent with all this. When price goes below to tap into the sell side liquidity pool and dip into this BISI, buy side imbalance, sell side inefficiency, using the institutional order flow entry drill technique, all it has to do is come down to that low, and that'd be enough to get an entry. Okay, so if we're looking for a bounce in here to trade back up into a premium array, which would be a bearish order block here, buy side liquidity pool, fair value gap, breaker mitigation, we can use the time while it's in this blue shaded area all the way up into, which it leaves it and goes above the 50 level of that range on the 14th of June. Okay, so for 4 days, we had the opportunity to study and look for opportunities for longs based on discount arrays. Now, when we have this in play, we could be looking for the external range demarkers. And so if we drop down to an hourly chart now, here's that gap opening. So there's no candle in here. Okay, we have a gap. So price comes back up, closes in the gap here. Is that gap efficiently balanced at that point? No, it's not. Only until it trades back down on this candle is it really balanced. Reason why is we have this gap in price. Okay, it's a volume imbalance. What's a volume imbalance? It's a missing range of price where only a previous candle and the next candle defines it. So it's a gap, basically. It's a simple gap. When price trades up, gap theorists say the gap is now filled. So therefore, it's no longer salient. That's not true. Price has only been offered on the buy side here. To be efficiently balanced, price will be dropped lower. So it gives us a buy and a sell. In other words, price has moved up and down in that range that's created that gap, or what's shaded in yellow. So once the price has been balanced, we have to wait for displacement. Okay, displacement is when IPTA moves strongly in one direction or the other. We don't really particularly care. But in this instance, we want to see if there's a willingness to go higher. And it does create a displacement here. Price creates a run, leaves an imbalance. So this is a BISI, buy side imbalance, sell side inefficiency. It's defined here. Now, at this point, when this candle closed and it was trading here, this was a fair value gap. But because we went down into the fair value gap here, now this becomes a buy side imbalance, sell side inefficiency. That is the distinguishing factor between a BISI and a fair value gap. So that way you understand what that is. And the reverse is said for SIBI and fair value gaps when it's a bearish inefficiency. Price creates a rundown into this BISI, and this is the actual low, that candle, and I have a Fibonacci just laid over top of that to delineate the central portion, okay, or consequent encroachment of that gap. Every wick is a gap, just like this is a gap here. Okay, this right here is a gap. It's not commonly referred to as a gap or seen as a gap in other schools of thought. So regardless of who your trainer was, whoever's trading or whatever, I don't care how long they've been trading, they're not going to look at a wick as a gap, but that's exactly what it is. The market is stretching or reaching for liquidity and doesn't stay there very long. So when price creates a wick like that, okay, and the reason why I also want to only use the external range demarkers on an hourly chart, it gives us time, okay? If we're using it on a 5-minute chart, you really don't have the luxury many times to work within the concept, and you'll see what I mean in a moment. So as soon as this candle closes, we can see there's a wick there. Now you don't see it because I have all the lipstick on it, so I'm going to take this off for a second. So there's that wick, okay? So if we can think about where this wick's midpoint, okay, or the consequent encroachment of that gap, because it's created a gap from where it's closed and where its low is. If I put it back on, and that's the wonderful thing about MetaTrader, it'll snap right to your open, high, lower, close. There's your midpoint right here. Okay, so 32,752. The low comes in at 32.75 and 1 pipette off, 3. Okay? This is all you need, plus spread. If you missed this entry here, you can take a fill, anything less than that close. Ideally, you want to see it trade down, find some support at that midpoint. Again, the midpoint is shown here at 32.75.3. Price creates an external range demarker here. Then you can participate as a long entry at that price point here, or anything below the previous close. It helps you define specifically where you're trying to get in at and what is a really discount entry point. Price clears this high here, and this here is old high. creates an imbalance again. This is a fair value gap. Why is it a fair value gap? Because it's only one single candle and nothing comes down into it until here. Bullish order block. 3 down closed candles. We have displacement. Bullish order block. Fair value gap. Overlap. Price can be bought here on the 13th. Now notice also, 13th, here's the 12th, here's the 13th. You're buying it down here in the wick, low. Closing in, all of the buy side delivery, sell side's been now offered on the next day. Going back to the hourly chart, price runs from that low, leaves these 2 down closed candles, bullish order block again. Same thing occurs in here. Take your fib, we have a wick dipping down into a discount array. This was a discount array, the BISI, trading down into a discount array. This right here is a discount array. If price comes back down to it and it's a bullish order block, you could be a buyer there. No real wick to work with in terms of an external range demarker. We do have one here trading back down into the order block. So if we take our fib, drop it on here. Let me be fair about it because I want to make sure it goes right on the low. Okay, you can see it's hitting right there. That price level, 33.18.1. The low, 33.18, again off by 1 pipette. So buying below this candle's close and between this expected low, anywhere in there is an ideal entry point using external range demarker. Another support area found on the order block here. Price creates another imbalance, leaves a fair value gap, bullish order block. Again, same price structure here. Price stabs down, closes in the gap. We're going to measure that wick as it dips in. Okay, and the low, I'm sorry, not the low, the consequent encroachment on this is 33.31.6. This candle, 33.30. So it's less than 1 pip. Or it's 1 pip really, essentially. So it's off by 1 pip there. Very, very, very tight. And again, this is a retail demo account. Okay, it's not the pristine things of an interbank price feed. It's very muddied up. So to be this precise is still very phenomenal. It's amazing that you can still see the visibility with IPTA, even though it's been chopped and screwed, really, that you don't get that much disparity from what you would expect to see. Now, extending it out 4 days, okay, so this is day 1, 2, 3, 4, you get to fill again here as well. So below that candle's close to this price level in here, anywhere in there, if you target that as an entry, that's ideal. Now, this is your previous swing low, so your stop would have to go below that. So even though we had a little bit of an overzealous movement here, it didn't take out this low, and it certainly didn't take out the previous swing low. Okay. Price rallies again, creates another fair value gap, and this is on the 14th. This is that day here. Okay, so that's when we had that big surge. This run up here creates a fair value gap. Price comes down, consequent encroachment nails it beautifully, splitting the range again here. This is that gap on that wick as it closes in that fair value gap or taps into fair value gaps, consequent encroachment. There's your price level, 33.96.7. The low, 33.95.6. 1 pip again, off by 1 pip. So the range is buying below this candle's close to this price point. Okay, anywhere between those 2 price points, again, the close is 34, and consequent encroachment is 96.5. That is not a zone. It's not ambiguous. Okay, it's very specific about what you're trying to buy. Why? Because it's bullish. Until when? here's that 34.2950 level. That's over here. This level, this high. 34.29.5. Okay, there's your minimum target. Okay, it needs to trade there or higher to fill it. On this day, on the 18th, it trades to 31.4 or 31.4 pipettes. So it only goes over essentially just about 2 pips. Once it trades here, same thing. We're looking at that range that's being defined by the wick. Midpoint right here. The price is 34.29. The next candle's high 34.29 and 7 pipettes. So selling above this candle's close to this candle's consequent encroachment on its wick of 29, you know exactly what price level you're trying to sell short at. And this reaction here, you would be targeting the liquidity resting below here and then completely closing in the BISI that would be remaining on the daily chart. And again, obviously you can get really carried away and say, okay, we're going to be targeting the next level of sell side liquidity, which is resting below here. That's all fine and great. That's not the point of the teaching, is that every one of these here, okay, these are very specific. It's not supply and demand zones, okay? It's not anything else out there. It's very, very specific. It's not pin bars, okay? It's none of that stuff. It's a very specific criteria. We have to trade down into a discount array each time when we have a bullish context. And also, big point, we're in a discount market, okay? Intermediate term price swing. We're anticipating another intermediate term price swing higher. What's it going to reach for, Michael? Well, you got to start looking at the bearish order block first. And if it goes through that, then you can look for the buy side liquidity and fair value gap, breaker, mitigation block. All of those factors. But everything goes to the low probability once we get above this midpoint. Okay, and if I highlight that, you can see the price level. 34 big figure, basically 3401. And 3401 is right in here. Okay, so probabilities fall off precipitously once we trade above that. But look what we left, equal highs. So you come down, pick up one more discount array, and then send it higher on the 18th, and then it just takes a bath. Okay, so hopefully this has been a little bit more insightful to what a external range demarker is. You can actually see some of them also over here. You get price trading up into a buy side liquidity pool. The fib is 32.25 and 3 pipettes, and the high comes in at 32.24 and 9 pipettes. So within a pip, again, selling above the close to specific midpoint or consequent encroachment of the wick. And again, I already know what you're thinking. Well, I see it, and this is really neat, but I'm not sure I'd be able to pick that out myself. You will get it. There's other things that I have to teach you that will fall into place, and then you'll see it. Please don't feel so confused or compelled that you got to send me emails. Like, can you teach me this? Can you teach me that? Show me how to. I already know that your understanding is incomplete relative to this concept. I just introduced it to you. Okay, so think about it when I first gave order blocks. You don't think I got 1,000 emails in the first month asking me, is this an order block or is this an order block? You're just now getting introduced to it. So allow me to flesh it out. Okay, we spent a great deal of time on fair value gaps recently. So now we're going to spend some time with this one. Okay, there's so many things we have to learn, but you have to give me the time and the required amount of time for you to digest certain things. Trust me, it will click, but you gotta spend time with it, and I will give you more information about it. So again, I'm going to counsel you to go through your charts, look at examples like I just marked up here, use the benefit of hindsight, mark up your charts and see where these external range demarkers occur. And remember, there's two of them. There's one that creates the low, and then it goes with a lower low, but it's basically just a measurement of the entire range duplicated. So if there's a previous wick and we trade lower than, and I mean significantly lower than consequent encroachment of the first wick, then you would anticipate a duplicate range, okay, or a standard deviation of 1. Whatever that initial wick was, it'll be another one of that. Okay, and like I showed in previous introduction to this theory. And then obviously there's other ones where you have price creating just a return to the initial candle's consequent encroachment, and that would be the extent of the low. So we would create a higher low. But this is occurring, this whole function, this is all happening in an area where you would be at a discounted array. Now, it would be reversed if we were trading up into a premium array and things were bearish. The same criteria would be seen, just in reverse, where you'd have price creating the initial wick up into the premium array. It could be a bearish order block. It could be a fair value gap that's bearish, a SIBI that's been closed in. All of those are premium arrays. We can get this formation or the next candle. If it trades up into a premium array on the first wick, then we don't need to anticipate a higher candle. We would just look for it to trade back up to its consequent encroachment of the first candle wick. So that would be like the lower high. Okay, just study these examples in here. Okay, and then go through and find a market that was bearish. And I'm going to leave this with you for your homework, and then we'll look at one on Friday. So the Friday's teaching will have this basically just in reverse. Okay? Trust me, don't send me emails saying you're not understanding this. I already know you're not understanding. Okay? Surgeons are not going out cutting on people the first time they talk about how sharp a scalpel needs to be. Okay? Just trust me. There's going to be more lessons on this. We're going to spend a couple weeks with it. So don't feel, confused or reluctant to, to put any consideration into it, because believe me, you're going to want to learn this one. It's really, really nice. It helps with, it's kind of like a second chance entry, or it could be a refinement, or it could be your confirmation type thing that you look for. Okay, because some of you would want to see that. It helps provide that sometimes. So not all the time, but sometimes. But again, without the market creating a wick into the discount array, or in this case when we were talking about if it was a premium array where it's stabbing up into something that we would see as bearish, unless it creates a wick, then we can't even consider the external range demarker. They're not going to be considered at all. So in other words, if we have like butt-ended candles like this, they're not going to create this scenario here. Okay, so it's something entirely different. We're just looking at the entirety of the fair value gap being closed in, and then returning back to the fair value gap and order block combination. There has to be a single wick created as it's going into the PD array. Okay, whether it be discount or premium. And if you don't know what I mean by that and you just started, trust me, when you get to the lesson where we teach the PD array matrix, you'll want to come back to this lesson, put it in your notes, write it down. When I get to the lesson talking about PD array matrix, look at the lesson on July 3rd, 2019. Okay, so these are all things that you have to do to manage your understanding and your learning. I'm going to reference certain things that you go back to in the core content, and you'll learn more from doing so. Okay, but we're going to go into more of it just in a reverse perspective for the cell side. So we'll be looking at premium arrays on Friday with this example. Again, we're talking about external range demarkers, and I guess if I put that up on the screen, this is what this is. This is what you're learning. Okay, so that's for your notes. Keep that in your book. Nobody talks about these things. It's all me. Okay, so just understand that you'll learn more about it in the opposite end of the spectrum, from a premium to discount, on this Friday. So on the 5th of July, we'll talk about that, and you'll get some more insights about it. But that won't be the last time we talk about it. Again, we're going to be spending some time with it because it's important to understand not all candles close but ended like this with very little wicks. Many times it creates these wicks, and they are signatures. They tell you a whole lot. There's accumulation that's taking place in there, and it is vital information for you to understand timing and also picking out setups. So until I talk to you on Friday, have a pleasant 4th of July weekend, and Lord willing, I'll talk to you on Friday.